G'day folks, welcome back to another update for natural gas. Now we've had a daily bullish breakout on the charts. We'll go through that in a minute, include some back testing as well. Make sure you hit that like and subscribe button before you go any further. Also reference the +1 videos to get a deeper dive into some of the trading strategies we talk about in today's video. In terms of the outlook, natural gas prices have climbed sharply in recent weeks, up roughly 20% over the past month and almost 50% compared to a year ago, despite inventories remaining slightly above average. The rise reflects a combination of slightly tighter production, very strong LNG export demand, and a shift in global flows as Europe leans more heavily on US exports and reduced Russian pipeline supplies. On top of that, renewed geopolitical risks, especially attacks on Ukraine's gas infrastructure and escalating tensions in key shipping or supply regions, have injected fresh uncertainty and premium into the market. Moreover, cooler weather forecasts in the US are boosting expectations of higher heating demand, all of which have combined to push prices upward. So starting with natural gas on the weekly chart, you can see that it's broken above the moving averages on both the price and the CCI, so that's bullish momentum if you're trading on the daily. We always go in the direction of the higher time frame. On the daily, again, we had a breakout on our last video. We're just waiting for that to also break out on the CCI, and it finally did, but that was confirmed. We had a massive gap up there after the weekend, and it's been doing quite nicely, and actually it's broken through that resistance we had previously at 38.21. I'm not going to draw another resistance yet. There's still potential upside yet, but at the moment it looks like it's moving in the right direction on the daily. Both the CCI and the price are above the moving averages, and there's no sign yet on the daily pullback. No divergence either. On the hourly, however, again, you can see there very clearly we've got a bearish divergence, and that's measured by that high on the CCI to that high there on that level of CCI versus the same period on the price. Higher highs on the price, lower highs on the CCI. It's a bearish divergence. Now, assuming it starts pulling back from here, it could go a lot higher, of course. So long as that keeps rising and the CCI keeps dropping, we're going to consider that a bearish divergence. But just to show you the exercise, assuming it starts pulling back, we take it back to that significant low, and we can expect a pullback near that moving average around the 23-38% Fibonacci range. Of course, it could go a lot further, but that's the minimum that we can expect, and more than 90% of the time it hits this minimum range. So that's the hourly. Now looking at the back test, again we're going in the direction of the daily, so going long from that period on the 3rd of September on the daily, and it's indicated here on the 1 hour chart. And the reason we mark those divergent trend lines is because we want to be able to see clearly from this list level. I like zooming out at this level because you can see there was a divergence playing out there. The first divergence occurred on that peak on the CCI, that little range there to that peak there, and that was your first, I suppose, warning. So eventually it does fall, the price and the CCI will fall over together, and that's what it did here. So then you avoid obviously going short during that period, because again you want to be going in the direction of the daily. Let it ride, and then we start going long again when both the price and the CCI break to the upside, and at that point you can see there it was moving up as well above the moving averages on the price and the CCI. Take another long entry, and you would have had a few little trades there. Now notice as well, avoiding these downtrends on the hourly, you avoid these drawdowns. Okay. Likewise here, there's the price and the CCI dropping off, you avoid that drawdown. But then also notice here we had a lower lows on the price versus higher lows on the CCI. That was a bullish divergence, and as soon as they both started turning up, you're into a trade. And again, notice there that was breaking out on the daily as well, and you go in with those minimal contracts. So each of these periods, I'm emphasizing, you avoid these drawdowns if you follow these moving averages and the trends and the divergence. And then finally back here, the price did fall off with the CCI. Again, you would have probably had a contract or two open there. You still would have been in profit, and you would have avoided that drawdown as well. Until more recently, getting into it, let me just zoom in on this one. Again, going long during this period, could have gone long in any one of those candles there, and that would have been a nice little return, especially with that gap up. Both the CCI and the price are above the moving averages, gapped up and kept going. Now, I like to close it out when the CCI breaks into the moving average range there, and that would have been still a nice little return. Or you can let it run till the moving averages are penetrated on the price chart. But just notice as well, we've got this bearish divergence at the moment. So again, you can let it run, but just be very careful. You have to get ready to pull the trigger to close out the trade if it does start breaking down suddenly. So this is BOIL on the weekly. First off, most of the momentum's to the downside with the prices below the moving average, and so is the CCI. A bit of a bounce there slightly, as you'll see later in the daily and the hourly. But again, that's predominantly still a bearish momentum, which means you take short trades only if you're trading on the daily. On the daily, you can see that it's broken up through the moving averages of the CCI and the price. Although notice that moving average range is still separated. What I'd like to see is generally, I'd like to see the moving averages, let's go back to this period. I like to see the moving averages turn up like it did back here, and the price break through that point as well. Like back here would have been ideal to go long. So at the moment it's a bit risky here, but still you can still trade it if you're trading on a smaller time frames. So this is the daily, still pretty much in consolidation mode, I would say, even though it gapped up according to the weekly. Well, the weekly did have a bit of a bounce, and the daily as well, up through that support we had previously. Now if you're trading on the hourly, you go in the direction of the daily, of course, that's the rule. And this would have been a bit tricky one. I'll show you on the other chart in a moment, but basically you start going long from this period, obviously, if you're trading on the hourly. It gapped up, and you're still being in a trade today. You notice there it's skimming along the top of the CCI. So as soon as that, according to my preference, as soon as that touches and breaks into the moving average range, I'd close it out. Sometimes if you wait for the price on the moving averages to be penetrated, you can lose some profitability because they can have a sudden drop. The CCI generally gives you a early warning to get out. Now looking at the back test, again looking at the daily as a reference, again notice this consolidation period, very risky actually, because you could have gone long there and potentially short there, and you might have had a couple of small little trades in that short positioning. But at the moment you'd be going long again, as I said, because of that rule with the CCI and the price breaking through that moving average range. Now notice back here on the close of our last video, on the hourly you're broken above the price and the CCI moving averages, but at that period you're still back on this candle here. You're still below the moving averages on the CCI. So I was going to say it's not the best trade you would have taken there, because you want to make sure that the daily is also in an uptrend, as I said. But just be cautious of this consolidation period. Nonetheless, if you got in on that candle there with that break above the moving averages confirmed by the daily, you'd still be in the trade, so that's a good little return there as well. Looking at KOLD on the weekly, above the moving averages, but notice it's pulling back. The CCI is already broken below the moving averages, so that's somewhat of a bearish momentum, but somewhat, I would call that a neutral positioning on the weekly with the price above and the CCI below. On the daily, it's actually hit that resistance at 41.80 and it's bounced down, and again the price is broken below, but there was a bit of a consolidation period there. Again, this is the inverse to the other charts, with the CCI breaking below the moving averages in the last couple of days. So that's a bearish momentum at the moment, meaning you can take short trades on the smaller time frames like the 1 hour. And here on the 1 hour chart, you can see there taking short trades from that period. Again, similar to BOIL in the inverse, you probably wouldn't have entered at that level there. And if you did, you're strictly lucky. You want to make sure you get in the direction of the daily. And you would have entered probably on that candle and still be in a trade today with the CCI not yet entering into the moving average range. Looking at the back test, again looking at the daily, you would have avoided, again you would have been lucky to get into that on that candle there, because that CCI is still above the moving average range. So you would have waited till that period there when it broke below. And that's what we've done here on the 1 hour chart for the back test, going short here, and you would have made a few little returns here with that, and that's still in a trade, as I said, with the CCI below the moving averages. So for UNG on the weekly, prices below the moving average, so there's bearish momentum there, likewise on the CCI, but notice the CCI is breaking into that moving average range, so that could possibly reverse. Looking at the daily, so that's if you're trading on the daily, you look at the weekly. So looking at the daily chart, you can see there it's bounced off or hit that support level at 1172, and again had a gap up into that moving average range on the price. The CCI has already penetrated through the upside. Again, notice that consolidation period on the moving averages. So again, a bit risky at the moment, could go either way, but at the moment it's bullish if you're trading on the lower time frames to take some very close long trades only. On the hourly, again, going along from that period when the price and the moving averages are above, the price and the CCI above the moving averages. And you can see there we had a bullish divergence back here. We drew a Fibonacci target range, and that was penetrated since our last update. So we took it back to that level, I believe. And that was the 23-38% range. It actually gapped right through it, penetrated through the 50%, and currently still above the 61%. Now if we look at that's the 1 hour chart. If we look at the back test, let me just get rid of this Fibonacci, clean it up a bit. Again, you would have been going short during this period. You would have had a couple of little short trades there, and then started going long again from this period on the hourly in accordance with the daily breaking above. So that started from here, which is actually this candle. Again, you would have probably missed out on that gap unless you risked it and had a bit of a gamble and got in early. But again, you want to go, if you want to trade in the hourly on its own, it's a bit risky. Always go in the direction of the higher time frame. But that's still in a trade with the CCI still above the moving averages. To get our insight into some of the share trading ideas, we do a weekly Patreon update, some bullish share scans, and these are some of the trades we've taken since the 21st of September this year. So about a month's worth of trading, we've generated about $3,600, and in percentage terms, that's about 9.65%. So again, if you want to get some access to that, subscribe to the Patreon page, links in the description below. Thanks for watching, hit that like and subscribe button, and we'll see you in our next update.